Okay, everybody, welcome to Accounting 610. The slides I have here are going to introduce the syllabus and introduce the course, and then cover a few concepts. This doesn't really count as the first module in the course, but instead is just a little bit of an introduction. The first module will be covered tomorrow, and just to clarify a couple things. One, I posted a syllabus in Blackboard yesterday, and then later updated that syllabus because I'd listed today's topic, I guess, as the first module, which is not what I intended. This doesn't really count as a module. The other thing I wanted to clarify is that on each Friday, I plan to post most of the materials for the modules that will be covered the following week. Of course, this week is different because we're just now getting started. What I will not post on Fridays are the recorded lectures. I plan to post each of those or to schedule them to be made available on noon of the day that we cover that module according to the course schedule and the syllabus. And so at noon, which is our normally scheduled class time, if we were having live meetings, you'll be able to go to Blackboard and view those recorded lectures. And I'm doing that for a couple of reasons. One, to sort of maintain a sort of normal summer term flow to the course. And second, to allow me to be able to discuss some of the assignments in the lecture and make sure that that discussion is not available, of course, until those assignments have been turned in. So anyway, with that little bit of a couple of clarifications, we'll jump right in and look at some of the items from the syllabus. Of course, my name is Kendall Boland. I don't know that I said that already. You probably know already who the instructor is supposed to be. The best way to get in touch with me during the term is probably going to be by email. My email address is kobowlin@olemiss.edu. You're also welcome to call me in my office. I'm going to try to be on campus a good bit, or be in my office a good bit, especially during our normal class times. That may not always be the case. I'm not always be here in my office. If I'm not here and you call, you're welcome to leave a voicemail. But that's probably not the best way to get in touch with me. My phone doesn't really tell me if I have voicemails, and I sometimes go for months without really checking. So if you leave a voicemail, I'll probably get it at some point, but it might be too late. So if you call and I'm not here, my recommendation would be to just send an email. My office is in Connor 314. That's probably not relevant to us this term, since we're practicing, of course, social distancing and that sort of thing. So I don't expect to be meeting with students in my office. But I do plan on a daily basis to offer office hours by Zoom. And so from 12 to 1:50, which is our normally scheduled class time, I'll be online and available by Zoom. So if you want to drop in to the Zoom address that you see here in the last bullet point, I'll be happy to chat with you about whatever issues. And so if there's something that you're confused about from the lecture, from the readings, or if you need help on an assignment, feel free to drop in during that time via Zoom. If that time doesn't work for you for whatever reason, I'm happy to make other appointments, or we can correspond by email. Your choice on that. But take advantage of those office hours, especially if you have confusion. Don't wait until the day before the exam to try to clarify some things. Just jump on Zoom and let's talk about it and get things figured out. Okay, now the course is broken into modules. Okay, so there are, I think, 14 modules for this course. Basically, we're going to cover one a day. One or two modules might be spread over a couple of days, but essentially we're going to cover one module a day. Each module will be based on a number of readings. Those readings are going to be available for free through Blackboard. So basically, if you go into Blackboard, into the content folder, you're going to see a folder essentially for every day of class. And each of those folders represents one module. So I've already posted modules 1, 2, and or modules 1 and 2 plus a folder for, of course, for today's lecture. Of course, if you're finding this lecture, I guess you've already found the content folders and at least the May 27 folder. But anyway, within each of those folders, you're going to find some readings for the day or for the module. Those readings are going to be available, are going to be for free. There's no textbook for this course, nothing to buy. A lot of the readings will be items online. And so, for example, a big chunk of the things that you're going to read are going to be audit standards, in particular PCOB audit standards. Those standards are available for free online. And so the readings in Blackboard will largely just link you to the PCOB's website and the most updated version of those standards. Each module will also include a discussion question item. This item will give you specifics on what should be read. Some of the readings are really, really long. For example, one of the readings is the Sarbanes-Oxley Act itself. I'm not going to require you to read the entire Sarbanes-Oxley Act because it is pretty long. And so this discussion question document will provide specifics on what exactly I want you to read, which sections or which paragraphs or which pages that I want you to read. It's going to provide due dates for assignments, and it's going to provide some questions based on the readings. And so my recommendation is that you read through all of those items, all of the readings, that you try to address the discussion questions that are based on those readings. Use those discussion questions to help kind of guide you to what is most important and that sort of thing. And then once you've done that, jump into the recorded lectures and read through and listen to those or follow along with those. I will also be posting PowerPoint slides to go along with the lectures. Those slides will include some blanks that you can kind of fill in as you go to help you kind of focus your attention and so on. For most modules, or at least for a number of modules, there will be some individual assignments. These are going to be available along with the readings in the module folders in Blackboard. You're going to submit these assignments through Blackboard as well. Each of the assignments will be due at noon on the day that they're included in the module folder. And so you'll need to maybe get a little bit of a head start on those so that you can complete those assignments. And then to the extent the lectures discuss those assignments or the solution to those assignments, that will of course be included in the recorded lecture that will be available at noon as well. If in some modules, we have what I'm calling group assignments. These would typically be assignments that I would that you guys would do in class in small groups. But of course, we're not going to be meeting live, so doing it in class in small groups is not feasible. And so essentially, these are going to be like any other assignment, except if you want to get together online or in person, if you're comfortable with that, with a couple of other people, you can work these out in groups and then just submit one solution for your group. Be sure to include everybody's name. If that doesn't work for you, or if that's not your preference and you would prefer to complete these individually, you're welcome to do that as well. All of these assignments will also be submitted through Blackboard. And then we're going to complete 3 group data analytics cases. These will also be modules along with the readings in Blackboard. These cases will take a little more time, or maybe a good bit more time than the group assignments do. These will require you to make use of Excel and maybe IDEA or other data, Tableau, other data analytics tools that you're comfortable with. The solutions to these cases should also be submitted through Blackboard. I'll assign the groups for these cases, and what I'm going to do is randomly assign different groups for each of the cases. So you'll be assigned to work with different people on each of the different cases. And I'll make those group assignments pretty soon once the class roster has kind of stabilized. The assignments and cases should be submitted on time according to the due dates. Those due dates should be clear in the assignments themselves. I'm not going to accept them late, except under pretty extraordinary circumstances with some reasonable excuse. So please be sure to complete those assignments and get them turned in. You want to definitely get credit for all of those. Typically, if we were meeting live, a portion of your course grade would depend on attendance and class participation and professionalism and that sort of thing. Since we're not going to hold live classes, it's going to be a little more difficult to participate in class discussion and that sort of thing. And so I'm going to replace this component of the course grade with quizzes for each of the modules based on the readings and the lectures. So after you've been through the readings, after you've followed along with the lectures, you'll want to complete the quiz. And this is typically going to be a pretty short multiple choice or maybe short answer, fill in the blank kind of quiz. And you'll have a couple of days after the lecture is posted to complete that quiz. The quizzes will be administered through Blackboard, and you can complete those when you're ready. But there will be a due date, typically about 2 days after the recorded lectures are posted. Okay, we're also going to have 3 midterm exams along with a cumulative final exam. The exams will be largely made up of short essay questions, along with maybe some listing type questions or short answer questions, or even some multiple choice or even true or false type questions. The bulk of the exam, I think, will be these short essay type questions. And what I mean by short essay is a question that requires a paragraph or so of response. But I will supplement those questions with some other types of questions as well. We will take the exams via Blackboard. Again, I'm trying to keep almost everything within Blackboard. But for exam security reasons, I'm going to also ask you to log in to Zoom while you take the exam, just for security and make sure folks aren't collaborating and that sort of thing on the exam. And the final exam, as I mentioned before, will be cumulative, but it'll be primarily based on the last week of modules. Okay, and so the bulk of that exam, probably 65 or 70% of the exam, will be based on those most recent modules. The questions from older material will largely be conceptual and will be the type of questions that I think at that point you should be able to answer without going back and digging through the old course materials. So at that point, I feel like you should be able, just off the cuff, to be able to answer those type of questions. Okay, the course grades will be based on the percentages presented here. Okay, so the quizzes, which are replacing class participation and professionalism, will be 5% of your course grade. The group data analytics cases will be 15%. So I expect to have 3 of those cases, and so each one will be worth 5% of the course grade. The individual and in-class, that should say the individual and group assignments, will collectively be worth 10%. Each one will be equal. They'll all be equally weighted, so each individual and group assignment will be worth the same amount. So 10% divided by the total number of those assignments. Midterm exams 1, 2, and 3 will collectively be worth 50%. Each of those 3 exams will be equally weighted. Okay, so 50% divided by 3, so a little less than 17% on each of those 3 midterm exams. And then the final exam will be worth 20%. I would expect that the final exam will probably, it won't necessarily be longer than the midterms, but it'll cover more material. And so that last exam will cover 5 modules, I believe, whereas the other exams will cover a smaller number of modules. Okay. All right, so that's it for the syllabus. If you have questions about the syllabus, feel free to send me an email or jump on my Zoom office hours beginning tomorrow, and I'll be happy to address any questions that you might have. The next several slides are going to just introduce some of the things that we're going to talk about during the semester, and introduce some basic ideas. And the first of those ideas that I want to introduce is just the definition of auditing, or what we mean by auditing, particularly in the context of this course. Okay, and so a very basic textbook definition of auditing. I believe I got this definition from the Beasley textbook, which many of you may have used in your undergraduate auditing course. And it says that auditing is the accumulation and evaluation of evidence about information to determine and report on the degree of correspondence between the information and established criteria. And there are a number of important ideas built into this definition that I want to focus our attention on. The first is that auditing involves the gathering and the critiquing and evaluation of evidence. Okay, and so ultimately in an audit, we're gonna come to a conclusion, and we're gonna draw a judgment, and that conclusion or judgment, or really maybe I should say opinion, is going to be based on the evidence that we accumulate. Okay, and so we're going to gather a bunch of evidence. We're not just going to gather evidence, but we're going to test that evidence, and we're going to critique that evidence. We're going to be skeptical about that evidence. Ultimately, we're going to evaluate the evidence, and we're going to evaluate the evidence on a couple of dimensions. We're going to evaluate the appropriateness of the evidence, and in a later module, we'll talk about what we mean by appropriateness. We're also going to evaluate the sufficiency of that evidence. That is, whether we have enough of that evidence. Okay, and part of being professionally skeptical in an audit context is, or maybe the sum total of being professionally skeptical, is in the evaluation of our evidence. Do we have enough, and is it appropriate? Okay, now the evidence that we gather is going to be about information. Now in the context of this course, there is a particular type of information that we're going to be focused on, and that information is the financial statements. Okay, and so in this course, we're primarily concerned with the audit of financial statements. And so the information about which we're gathering and evaluating evidence is going to be those financial statements. Now, our objective in accumulating and evaluating this evidence about the financial statements is to be able to come to a conclusion. And the conclusion that we're going to come to is about the degree of correspondence, that is the degree to which the information or the financial statements is consistent with some established criteria. And so a question you might have is, okay, what does that mean, established criteria? Well, essentially what it means in our context is the accounting standards. Okay, and so financial statements are prepared in accordance with the accounting rules, with the accounting standards. And we can't interpret the quality, really, of those financial statements without that criteria, without those standards. Okay, so the standards are going to tell us how we're going to measure things. And so in some sense, we might think, well, the objective of the auditor is to make sure that the financial statements represent the economic reality of the company. That those financial statements really represent what has happened to the company and what the company's current status is. So, for example, we want to make sure that the financial statements are accurate in the sense that they report the actual amount of cash that the company has, or we want to make sure that the financial statement, or assure people that the financial statements are accurate in the sense that they accurately report the amount of revenue that the company earned during a period of time. But how do we know what is the appropriate amount of cash to report, or the appropriate amount of revenue to report in those financial statements? Well, that's going to depend on how we measure those two things. There are multiple ways that we could measure cash. And so we could measure cash as the amount of currency that we have on hand, that the amount of coins and dollar bills that we actually have on hand. Or we could measure cash as the amount of that currency plus deposits at banks. Or perhaps we could include in our measure of cash certificates of deposit, or very short-term investments. And so whether we include those short-term investments or those CDs in our measure of cash is going to depend on the accounting rules. And it's not something for the auditor to subjectively determine on his or her own, but it's got to be based on how the accounting standards say we should measure those things. And likewise with revenue, there are multiple ways. And perhaps in an accounting theory course, you would think about the multiple ways that you could measure revenue. And so maybe we measure revenue based on the amount of cash we receive from a customer. Okay, and so that's one potential way to measure the revenue. It's not an accrual-based way, but it is one way. Or maybe we can measure revenue based on the work we've performed for a customer, or based on products we've provided to a customer, regardless of whether we've received cash for those services or not. And so that's an alternative way to measure revenue. And so if the auditor is going to determine whether the reported amount of revenue is quote unquote correct or not, the auditor has to know how that revenue should be measured, and the accounting standards are going to provide that measurement criteria. Okay, and so without some established criteria, or without some accounting standards, we really can't audit a set of financial statements, because we don't know, outside of that criteria, we don't know how the items reported in the financial statements ought to be measured. Okay. Now, of course, we're not going to just determine the correspondence between the financial statements and the accounting standards, but we're also, and a big part of auditing is reporting on that correspondence. We're reporting our opinion about the degree of correspondence or agreement between the financial statements and the accounting standards. Okay, and so we're not simply making a determination and keeping it to ourselves, but we're going to make it known to perhaps the public, or at least to other parties who can use our conclusion, to make decisions. Okay. Now, the focus of this course is primarily going to be on financial statement. Okay. And the definition that you saw on the previous slide is a pretty generic definition. It could apply to audits of other things. So it could apply to an audit of a tax return. It could apply to an audit of internal controls. It could apply to other types of audits as well. But in this course, we're going to pretty narrowly focus on financial statement auditing. And really, we're going to focus on the audit of public company financial statements. Now, we will talk about audits of the financial statements of non-public entities, privately held companies, and not-for-profits. But we're going to primarily do that just to draw contrast between the standards for audits of those privately held companies and not-for-profits and audits of, or the standards for audits of public companies. Okay. Now, of course, while we are going to focus primarily on financial statement auditing, we all know that CPAs provide a lot of other services. For example, compilations, other assurance services, other attest services. CPAs issue comfort letters. CPAs provide internal audit services and tax services, advisory services or management consulting services, IT security reviews. We could go on and on. The profession is kind of continuously trying to broaden the scope of the services that come under the umbrella of accounting professional services. And so a question that I think is appropriate for us to ask is, where does auditing fit among all of those professional accounting services? Well, this diagram, I think, illustrates that for us. And so this is sort of a global diagram of professional accounting services. And in general, at least in this diagram, we've broken those services into two groups, two primary groups. And those are assurance services versus other professional services. And so I want to focus primarily on assurance services because it's within assurance services that financial statement audits lie. But an assurance service in general is an independent professional service that improves the quality of or certainty about information for decision makers. Okay, and so this is a pretty broad subset of professional accounting services. And it's any of those services that improves the quality of information for decision makers. Okay, and so within that assurance services umbrella or subset, you're going to have a smaller class of services that we call attest services. Okay, and I'll come back to attest services in general. Well, let me just go ahead and define attest services, and then we'll talk about assurance services that are not attest services. Okay, so attest services are a subset of assurance services and are characterized by the issuance of a report about a subject matter or assertion that is made by another party. Okay, so in an attest service, someone has put forth some idea as true. Okay, and they're, in other words, they're making an assertion about some subject matter. And what that subject matter is can vary greatly. And that subject matter can be many, many different things. And then the accounting professional in providing an attest service is going to provide essentially an opinion or at least a conclusion about essentially the veracity of the assertion that this other party is making. Okay. Now, if we go outside of attest services and think about other assurance services, we have just a huge variety of services. And so, for example, risk assessment services, so helping companies or organizations assess risk, is a type of assurance service, but not necessarily in a test service. Business performance measurement, so helping companies measure their performance or measure the performance of others, is potentially an assurance service. Evaluating the reliability of information systems is an assurance service, and so on and so on. We can probably imagine a lot of different services that a professional accountant could provide that would improve the quality of information, but wouldn't necessarily include issuing a report that contains a conclusion about an assertion. Okay, so now let's go back to the subset of a test services and look at some of the things that are included as types of a test services. So first of all, financial statement audits, which is the primary subject of this course, is a type of a test service. Okay, so management in preparing a set of financial statements is making many assertions about the items within those financial statements. And the auditor is evaluating the veracity or the truthiness of those assertions, and then issuing an opinion on those financial statements and implicitly on all the assertions built into those financial statements. But also reviews of financial statements or reviews of interim financial information would also be in a test service. Audits of internal controls over financial reporting would be in a test service. And then other agreed upon procedures that includes testing and reporting on an assertion made by another party would also be included as a test services. As it turns out, the type and variety of a test services is tremendous. And so if you can imagine a subject matter that someone would make an assertion about, then you could provide in a test service regarding that subject matter or that assertion. So, for example, if someone is wanting to sell a diamond, they might hire a professional accountant to attest to the quality of that diamond. Now, that doesn't necessarily require the accounting professional to know a lot about how quality of diamonds is measured, but based on how that quality is measured, the professional accountant could attest to whether the quality of that diamond is measured appropriately given the standards for measuring that quality. When I was at Ernst & Young, we attested to the frequency with which Coca-Cola or Coca-Cola bottlers were putting winning bottle caps on Coke bottles. And so they don't seem to do this a lot anymore, but back then the soft drink bottlers would often have contests where they would have messages under the bottle caps of Cokes, and you would open the bottle cap and look, and you might win another Coke for free or some other prize. And the companies would advertise the frequency with which people would win one of those prizes. And so at Ernst & Young, we would attest to the frequency with which Coca-Cola bottlers were putting winning bottle caps on their Coke bottles. And so we could give an opinion. They were making an assertion about it. We could test it. And so that was an attest service. Okay, now other professional services include things like tax services and accounting and bookkeeping services and management consulting or advisory. Notice that there's an overlap between assurance services and other professional services, in particular consulting or advisory. Okay, so a lot of services that we think of as consulting services or advisory services would also come under the umbrella of assurance services. Okay, and so it's important to recognize that there is some overlap there. Okay, All right, so I've talked about different types of attest services already, so I won't belabor that point and rehash that here. The one thing I would point out, and in the, I think, module 13, we're going to come back to this point, but a review of historical financial statements is in some ways similar to an audit of historical financial statements, but we are providing less assurance. Okay, so the objective of a review is different, and less than the objective of an audit. And then because of that, the procedures that we would perform in a review are going to be less intensive than the procedures that we would perform in an audit. And principally, in a review, we're going to perform analytical review procedures and inquiries, whereas in an audit, we're going to do detailed testing of individual accounts and that sort of thing. In other words, we're going to perform some more substantive type procedures in an audit that we would not perform in a review. Now, for the purposes of this course, there are several types of audits that we're not really thinking of as auditing. Again, just for the purposes of this course. So operational audits, efficiency audits, in other words, things that we would think of as internal auditing, are not really what we're thinking about as auditing for this course. Tax audits, not really part of what we're thinking about here, other compliance audits. And then certainly bookkeeping and consulting, things that aren't really attest services are not part of what we're thinking about as auditing for the purposes of this course. Okay. Now, the way this course is organized, or at least the way that I think of the modules as being organized, is consistent with the way in which an audit flows. Okay, and so the first part of the course, we're going to kind of focus on things that are outside of the individual audit and things that are sort of part of the environment in which auditing is occurring. And so we're going to focus first on the purpose of auditing and why we have auditing and what we're trying to accomplish with auditing. And then we're going to, based on that, based on what auditing is there for, what its purpose is, we're going to think about the characteristics and the values of the auditor. Okay, and so what allows the auditor, what about the auditor allows him or her to accomplish the purpose of auditing? Of course, the purpose of auditing and the characteristics and values that we want in an auditor are going to influence audit standards. Okay. And so the profession is, or others, in the case of public company audits, will set standards based on their understanding of what auditing is there to accomplish and what we want from an auditor. And then those standards are going to influence the actual conduct of the audit process. Now, within the audit process, I sort of conceptualize that process in 3 steps. The first step is the audit planning part of the process, where we evaluate things like materiality and risk, where we determine the types of procedures, substantive procedures that we're going to perform. And then the second step in that process is what we call field work, which is when the auditor is gathering evidence about the financial statements. The evidence that auditors gather will be through what we call a test of details, and then also through what we call substantive analytical procedures. And then the third step in the process is the wrap-up phase of the audit, where we evaluate the results of the audit and prepare the audit report. Now, this process, this auditing process, occurs within the context of a regulatory framework and quality control mechanisms. Okay, and the existence of that regulatory framework, or the structure of that regulatory framework and the structure of the quality control mechanisms, is going to be influenced by the history and the evolution of of the audit and the audit environment. Okay, and so over time, things have happened in the world, and things have happened in financial reporting that have led us to the place where we are now in terms of regulation, quality control, audit standards, and so on. These things are also being influenced by technology. Okay, and so as technology has changed, the way we conduct audit planning and field work and even the wrap-up part of the audit has changed. So the audit process has changed, but that technology has also influenced the structure of auditing standards and so on. Okay, and so in general, the flow of this course is going to follow this diagram. We're gonna first think about the purpose of auditing, the characteristics and values of auditors. We're going to talk about audit standard setting, and then as part of thinking about audit standard setting, we're going to consider the influence of technology and history and evolution. But then as we go through the audit process, we're going to also, we're going to talk about the audit standards over each of these phases of the process. But we're going to think about how history and events have influenced how those standards are structured and how audits are conducted. Okay, so one of the last things I want to do here today is introduce you to a discussion on the purpose of accounting and in particular financial statement auditing. Okay, so if we take a typical business, most businesses are begun by a single individual or maybe a small group of people, the original owners or investors in this business. And they start the business and they grow the business. And then at some point, maybe because they get to a retirement age, or maybe because the business becomes too much for them to handle maybe on their own, they begin to delegate some responsibility for running the company to other people. These other people we call managers or management. We can think of these other people as the CEO or the president of the company. And we can think of them as being distinct from the owners of the company. Okay, so perhaps the owners feel like they need more sophisticated folks running the company because the company's become more complex. Maybe they don't want to spend as much time running the company anymore, and so they hire someone else to do that for them. And so what this means is that those owners and investors are no longer as involved in the day-to-day operations of the company or the organization, and therefore they are also less informed about what's going on inside the company and how the company is performing. And so, in other words, you could say that they lack information about performance. And so to overcome that, management prepares financial statements to inform the owners or investors about the company's performance. Unfortunately, this creates a conflict of interest because the financial statements don't just tell the owners and investors about the company's performance. The financial statements tell the owners and investors about management's performance and gives the owners and investors information that they can use to determine how to compensate those managers and how much to compensate those managers, but also whether to retain those managers or to hire some new ones. Okay, and so the manager should prepare the financial statements in a way that is most informative to the owners and investors about the performance of the company, but those managers have incentives to prepare those financial statements in a way that reflects positively, not just on the company's performance, but on their own performance. Okay, and so this creates a conflict of interest. Again, on one hand, managers have a responsibility to create truthful financial statements that are informative. On the other hand, they have incentives to misstate those financial statements to make themselves and the company look better so that they can keep their jobs, or get a promotion or get a raise or earn a bonus or what have you. Okay, now the owners and investors understand this or potentially understand this. And so for that reason, they might lack trust in those financial statements. And if they lack trust in the financial statements, they may be unwilling to invest. And so if we kind of include in the group of owners or investors, the group of potential investors, who again might recognize that the financial statements are prepared under this conflict of interest. Those potential investors may not trust the information in the financial statements, knowing that it could be biased, and therefore, to protect themselves, they might not invest. And we've seen this occur multiple times throughout history, where the market, the investing market, becomes distrustful of information about companies, and they pull back from investment. We saw this during the financial crisis in 2008, particularly in the real estate market. We've seen it other times as well. And so the not just the viability of a company and the ability of a company to grow by attracting new investors, not only is that one company at risk because of this conflict of interest and because of potential bias in financial reporting, but the market in general and the economy in general are at risk because of this problem. And so this is an important problem that needs to be resolved. Now, how does it get resolved? Well, these managers, or at least in a sense, these managers, we probably should say the company itself, hires an independent auditor to do what auditors are supposed to do an audit, to accumulate and evaluate evidence about the financial statements to determine whether those financial statements were prepared in correspondence with the accounting standards, or whether they were prepared based on some manipulation by management, or potentially through based on some errors. And so because management or the company hires this independent auditor, investors are more willing to trust the information in the financial statements based on the auditor's opinion, and more willing to invest. Okay, and so a question you might ask, well, why would investors trust the audit and the audit report when the auditor is being hired by management or by the company? Why does the auditor not have a conflict of interest? And that's a good question. And it's a question that the public has asked. It's a question that regulators ask, in particular the SEC. It's a question that Congress has asked. It's a question that the accounting profession should ask and has asked. And so the answer to that question is very important, because this whole thing sort of hinges on the trustworthiness of the auditor and the belief that the auditor is somehow above the fray in terms of incentives and bias. Okay, and the key issue here, or one of the key issues, is the adjective attached to the auditor, the independent auditor. Okay, and so we believe and we hold sort of sacrosanct the idea that the auditor is independent, and while the auditor might be hired by the company or by management, it might be compensated by the company, the auditor is, in his or her mind, independent of the company, and more importantly, independent of the financial statements. Okay, and so we'll come back to that issue in a later module and think a little more about the importance of this independence and how this independence is maintained and so on. But it's important that the auditor is independent, and the auditor, him or herself, is trusted and credible. Otherwise, the auditor has no trust or credibility to give to the financial statements, and the whole thing sort of falls apart at that point. Okay, now with that in mind, we can talk about the purpose of the audit versus the objective of an audit. I should say the purpose of auditing versus the objective of an individual audit. If we look in the US standards, in particular the PCOB standards, and more specifically in AS 1001, we see this statement that the objective of the ordinary audit is of the financial statements by the independent auditor is the expression of an opinion. Okay, and so AS 1001 here describes the immediate objective of an audit, an individual audit, and that's to express an opinion on the financial statements. But this doesn't really get at the purpose of auditing because it doesn't really explain why we need that opinion or what that opinion is doing for us. Okay, the international standards come closest to answering this question. So if we look in ISA 200, it says the purpose of an audit is to enhance the degree of confidence of intended users in the financial statements. And so if we go back to this diagram, the purpose of the audit here is to give those owners and investors a reason to trust the financial statements, a reason to be confident in the information contained in those financial statements. And that's the purpose of auditing. The way in which that is accomplished is through the auditors expressing an opinion. Okay, and so the objective of the immediate objective of the audit is to express an opinion, but that's in service of accomplishing the purpose of auditing, which is to give credibility to the financial statements. Okay. The ASCPA standards, AUC 200, also reflects this as well, but it kind of uses the words in a different way than the way I would use them. The ASCPA says the purpose of an audit, not auditing as a general concept, but the purpose of an audit is to provide financial statement users with an opinion, which then enhances the degree of confidence that intended users can place in the financial statements. Okay, and so what they're really saying here is the purpose of auditing is to give credibility to the financial statements, and that is accomplished through the expression of an opinion. Okay, now, the auditor's responsibility then is to express that opinion. And so then the question is, okay, what sort of opinion and is the auditor to express, and what is the auditor to express an opinion about? And so expressing that opinion requires the auditor to obtain reasonable assurance about whether the financial statements are free of material misstatements, whether caused by error or fraud. Okay, and so then the question is, well, what is assurance? Assurance is the level of certainty someone can have in their mind. Okay, and so if I'm assured of something, I can trust that thing. I can be certain in its truth. If I'm not assured of it, then I'm going to be skeptical of its truth. And then what is reasonable assurance? So the auditor isn't just obtaining assurance, but the auditor is obtaining reasonable assurance. And so the audit standards tell us that reasonable assurance is a high but not absolute level of assurance. So the auditor's responsibility is limited in this sense. The auditor doesn't have to provide 100% assurance that the financial statements are free of material misstatement, but the auditor does have to provide a high level of assurance that the financial statements are free of material misstatements. Okay, and then the last question here is a question about materiality. And so what we're saying here is that the auditor needs to obtain reasonable assurance about whether the financial statements are free of material misstatements. Okay, and so we're not providing assurance about whether the financial statements are free of any misstatements. In fact, we are providing no assurance that the financial statements are free of immaterial misstatements, small misstatements, or misstatements that don't matter. The auditor is only providing assurance and only providing reasonable assurance about whether the financial statements are free of material misstatements. That is, the misstatements that matter. And so when we answer the question, okay, what is materiality? Well, materiality is the characteristic of a fact that makes it matter to a decision maker. Okay, and so a fact, a piece of information, is material if it makes a difference to the decisions and judgments that people make. If it doesn't make a difference, if it doesn't matter to the decision maker, if a piece of information in the financial statements or a misstatement in the financial statements doesn't impact the decisions that an investor makes, then it's not material. Okay, and that relates to the audit and audit assurance, because we're only providing assurance that the financial statements are free of misstatements that matter, that are material. Okay, now the auditor has a responsibility in the audit context, but management has a responsibility, or I should say the auditor has a responsibility in the financial reporting context, but management has a responsibility as well. Okay, and the financial statements are management's responsibility. Okay, it's not the auditor's responsibility to prepare the financial statements. It's not the auditor's responsibility to make decisions about the way things are accounted for. That's management's responsibility. And so management's responsible for adopting good accounting policies, establishing and maintaining good systems of internal control. The transactions that an organization engages in are under the control and the direct knowledge of management. The assets and liabilities of the company are under the control and the knowledge of management. But the auditor's knowledge of these things is limited. The auditor, like the investor, is not there every day. They don't see what's going on. The auditor, like the investor, is not necessarily an expert in the company, in the industry, or in business. And so the auditor's knowledge is limited. Now, and so this is the reason management is going to be responsible for the financial statements, despite the fact that management is potentially biased and under a conflict of interest in preparing those financial statements. If we had someone who was as knowledgeable as management, but not under the conflict of interest, then maybe we would prefer that group or that person to prepare the financial statements, but we don't have anybody that meets that criteria. Okay, and so management has to prepare the financial statements. Management has to be responsible for the financial statements because management has the knowledge to prepare those financial statements. Okay. Now, management's responsibility also includes, at least in some cases, the relationship with the auditor. Historically, management selected the auditor and negotiated audit fees and the timing, and even negotiated the results of the audit. In audits of public companies, Congress has taken that responsibility away from management, or at least ostensibly has taken it away from management and given it to the independent audit committee. Okay, and so now for public company audits, the audit committee of the public company hires the auditor, negotiates audit fees and the results of the audit, and so on. Okay, because, and this has happened because there were questions about the auditor's independence. So if management has a conflict of interest and management is in charge of the relationship with the auditor, that leads to questions about whether the auditor really can be independent, and the auditor's independence is paramount and one of the key issues in the auditor's ability to sort of give credibility to the financial statements. Okay, so that's pretty much the end of this introductory sort of lecture. I want to leave you with a few questions to think about for Module 1. First, why do we need auditing? We've kind of touched on that already. I want you to think about that some more as you go through the readings and complete the assignment. What makes auditing useful? So what about the auditor makes his or her service useful? And then what would happen if we didn't have that auditing? How would things go for a public company and within the economy in general? Okay, so be sure to check out Module 1, which is the May 28th module. That module includes an assignment that will be due at noon tomorrow on the 28th, so be sure to complete that module and complete that assignment. And then at noon tomorrow, I will post a recorded lecture related to that next module. Okay. If you have any questions, feel free to contact me by email or by phone, or to join in my Zoom office hours tomorrow at noon.